Putting your money in real estate could be the best decision or the worst decision of your life. It really depends on which real estate you buy. I'm Palmy Kitti, the other half of the Kitti Sisters. My sister Nancy and I have scaled to nearly $500 million in assets, returned $45+ million to investors, and have helped families preserve $110+ million in taxes. So this list is not an educated guess. These are real numbers from real deals from people who've actually done it. Warning though, some of these are the assets I love most on earth. And a couple of them, they'll dress up like wealth and hand you a job. Or worse, 7 ways to invest, 7 unfiltered data-backed rankings. Let's steal the homework. Let's start where the cameras always point. House flipping. The before, the afters, the sledgehammer montage. I know it gets you guys riled up to think about that. The reveal where somebody made $90K in 90 days. You've seen it 100 times. Here's what the shows don't put on screen. When you flip, you didn't buy an income-producing asset. You bought inventory and you handed yourself another job. Ask us how you know. Buy it, fix it, sell it, then wake up the next morning with exactly $0 of recurring income and doing the entire thing over and over again. Miss on a rehab budget, miss on the timeline, miss on the exit, and the whole spread you were chasing is gone. I have a friend who bought a property that she wanted to flip in San Francisco. Now today you may say, wow, I hear about all these amazing things happening in San Francisco. People are buying homes like $1 million over ask with Anthropic shares. That's all fine and dandy. But consider that she had a property that she held for 9 months before even one brick was turned or one sledgehammer was swung. Because guess what? The city didn't approve. 9 months of just sitting there collecting cobwebs. More important than that, collecting interest payments. Because 9 months isn't free. You're most likely borrowing money, maybe from a hard money lender. Maybe they're charging you anywhere between 8 to 12%, depending on the state. And you're paying that every single month with or without you moving ahead with the rehab. So yes, today she may be helped by the market conditions, but the cost probably outweighs what she'll be able to make right now. You're not an owner. You're a contractor with market risk. And every dollar you make, you have to go re-earn from scratch. There's no tide coming in behind you. There's no tenant paying you while you sleep. There's just the next house. This is not the kind of ownership I'm building. Final ranking on flipping, F tier. It can pay, so can a job. That's the problem. Next up, the darling of the last 5 years, short-term rentals. The mountain cabin that prints on weekends. The condo with the drone shot. And look, they can absolutely work. I'm not going to pretend they don't. But nobody tells you what you're actually signing up for. You've got operating intensity. This is a hospitality business wearing a real estate costume. You've got seasonality where half of your calendar carries the other half. You've got a platform dependency where one algorithm change on one booking site rewrites your income. And in a lot of markets now, you've got regulatory risk. The last one is the killer. One city council meeting, one rule change, and the underwriting you bought property on, gone. This is a story right now that's happening in California, in Southern California, desert communities. I see a post recently on X that says there's 600+ listing for home sale in the valley, in the desert. And guess how I can tell that they're actually short-term rentals? These 662 units that are being listed right now for sale all come furnished. Guess who furnishes their units and leave them to be sold? Short-term rentals. So you can see wrong underwriting can kill your deal fast. There's too many moving pieces for the money. D tier. A great side hustle disguised as passive income. Now this one, you're probably going to think I'm putting syndications as S because syndications are literally part of what Nancy and I do every single day. So watch this closely. A syndication is not an investment strategy. It's a structure. It's a wrapper, and a beautiful wrapper cannot save you from a bad operator. I watched people pour money into a great deal that was really just a great pitch deck attached to the wrong person. So stop asking, is this a good syndication? That's the wrong question. And it's a question that loses people money. Start asking, who am I handing my money to? Because the operator is the deal. The structure is just the paperwork around them. As a category, judge the way most people invest in it, chasing the structure instead of vetting the human. It's F tier. Not because syndication is broken, because the way people choose one is. Okay, let's get into what I actually own. B and C class multifamily. Workforce housing, the unglamorous apartment buildings where regular people live regular lives. I love this asset class. We've owned plenty of it. It's a real demand, real people, real rent, and it's the backbone of how a lot of wealth in this country got built. But right now, I'm paying very close attention to collections, to delinquencies, to insurance premiums that keep climbing, and to one quiet question: how much pricing power does a renter in this specific building actually have? Because at this income level, when the economy tightens, you feel it first. Great long-term asset class, but today I'm going to be more selective than I ever been. So it lands at B tier, not because the model is weak, but because the moment demands you pick carefully. Now let me tell you about the least sexy thing ever: self-storage. Boring metal boxes, a field, a fence, and a bunch of rolled doors. Not exciting, not complicated. Nobody's making a Netflix about it, at least unless you find interesting things in it, right? And that's exactly the point. In the right market, those boring boxes produce remarkably durable cash flow, low staffing, sticky tenants who forget they even pay you, and demand that shows up in a boom and in a downturn. People upsizing, downsizing, moving, divorcing, dying, hoarding. Life keeps generating stuff. Stuff keeps needing somewhere to go. Sometimes boring is the whole strategy. A tier. Speaking of overlooked, retail and industrial. Everyone spent a decade telling you retail was dead and warehouses were only for giants. And underneath that noise, some phenomenal opportunities got left on the table. But here's where it gets serious. This is the asset class where knowing exactly what you own decides everything. Tenant credit, who's actually paying the rent, and can they? Lease terms, how long and on whose terms? Replacement rent, if they leave, what does the next tenant really pay? Location, and building functionality. And can anyone else even use the space? Or was it built for one occupant? One bad assumption on any of those and the deal you underwrote is not the deal you own. Get it right though, and few things are stronger. A tier, for the investor who does the homework. Alignment for the ones who don't. And now the one at the top, A-class multifamily. This is home turf. Let me tell you what happened at one of our properties recently. In a single week, 12 tours, 4 applications, and you may say, that's not a great ratio, right? And the problem was not finding renters. The problem was we were running out of units. The rest went on to a waiting list. Sit with that for a second. Stronger collections, higher income renters with a real cushion, and in the right market, demand so deep, you're turning people away, not chasing them. Because underneath every trend, every headline, every interest rate cycle, one rule never stops mattering: supply and demand. When you own the newest, the best located, most wanted units in a market that isn't building enough of them, you're not hoping the tide comes in. You're standing where it always does. That's why for us, this is S tier, the asset we build around on purpose. So here's the board one more time. S tier, Class A multifamily. A tier, self-storage and retail and industrial. B tier, Class B and C multifamily. D tier, short-term rentals. F tier, house flipping and real estate syndications if you're picking the structure instead of the operator. Now pick the one that matches your capital, your risk, and your timeline. Then do the things almost nobody does. Spend real hours studying, not watching another video about it. You just did that. Study it. What does the deal look like in your market? Who's the operator? What's the real rent? If you want the shortcut, how will we underwrite these? Spot the operators worth backing and use AI to do in an afternoon what used to take our team a week. I'm teaching all about this in our free Real Estate Investing X AI Masterclass. It's free, it's fast, and it's exact framework we use with our own money. Link is in the description below. Come learn it, then go build it. Governance beats returns. The asset you pick decides the ceiling. Choose like it's generational, because it is.